They're all out there waiting to hear from you.
Great.
Okay, cool. I'm going to go on mute.
Hello, I'm Carol Spain, a director with S&P Global Ratings U.S. Public Finance team. I primarily cover as an analyst state governments, but I've been working as an analyst for state and local governments in schools for the past 10 years, including public libraries. My very first job actually in high school was with my public library, and I worked part-time for the University of Notre Dame Library while I was attending college, so I am very delighted to be able to speak to your group. At S&P, I'm part of our ratings team, which analyzes the fiscal condition of governments, including economic conditions. And today, I'm hoping to provide a landscape of what we are seeing for state and local governments, and which I believe will provide insights into the funding backdrop for libraries. So let's begin with just a little bit of a primer on how libraries are funded. This can be tied in large part to the funding landscape for state and local governments. So I've represented a little bit of background on their funding sources here. These entities are largely tax funded, although the revenue makeup can vary widely from state to state. Local governments in general are more dependent on property taxes. States, on the other hand, are primarily sales and income tax dependent. And these tax receipts broadly reflect the health of the overall economy. In addition to sales taxes, state and local governments place levies on hotel stays, liquor sales, gas consumption, and other sources which can reflect more specific sector trends. Roughly 1/3 of local revenues are intergovernmental, which is mostly in the form of state aid. Federal support for state and local governments is generally tied to a specific program, coming from the form of a grant for a project, or in the case of states, is primarily earmarked for Medicaid. So second, we definitely have seen the impact of COVID-19 and related social distancing restrictions and the sudden economic lockdown have a swift impact on state and local revenues. So the chart that I'm presenting here shows the first 3 months of 2020 relative to the first 3 months of 2019, and then the same for the next 3 months. So primarily, after March, we are seeing the impacts of COVID-19 showing up in the revenues. And you can see that we're coming from a really strong first quarter where we were seeing strong growth and then a sudden decline, particularly at income taxes and sales taxes. Although I want to say that there's a caveat here in that there's a lot of noise when we're thinking about income tax receipts. Many of the states had delayed their income tax filing deadlines. You may recall that the federal tax filing deadline was delayed until July, and many states and localities chose to delay their filings as well. So some of that decline was really related to a change in date because the income being taxed was in 2019. But sales taxes are a great indicator of really understanding what's going on with the economy. These typically come in about a month later and are more of a real-time indicator. One of the things I wanted to highlight here is that you can see property taxes are actually very stable. This is really an area that we'll continue to talk about. We're actually seeing greater stability than we are on the sales taxes. But there is a lag. So typically, the local government will assess property taxes for 1 year, and then the collections are set for that upcoming levy. So it really varies more on an annual assessment process. And so we're not necessarily expecting to see real-time impacts of COVID-19 on property taxes. States and local governments levy other taxes, as I had discussed, that are particularly impacted by social distancing. So specifically convention centers and hospitality taxes, so hotel, food and beverage taxes we're seeing very significant declines. In some of the hotels taxes that I cover, we're seeing more than 80% declines in the second quarter of fiscal 2020, and this is likely going to be continuing throughout the year. But as we discussed previously, these more specific taxes are a minor component of overall taxes. It's really more property, income, and sales taxes that we're looking at for the health of local governments. So if we're talking about how these taxes really reflect trends with where our economy is headed, I thought it'd be useful for us to discuss S&P's outlook for the economy. As of our June forecast, which is our most recent economic forecast, we see full year GDP contracting 5% over 2020. S&P Global Economics estimates it will take about 2 years for US GDP to regain its year-end 2019 level. Unemployment will remain high, consumer spending depressed, and business demand covering only slowly. That said, barring a second wave of COVID-19 that forces states and regions to reinstate lockdown measures, which is our downside scenario depicted with the blue dashed line, we anticipate that the recovery will take hold in the third quarter, which is where we are now. Growth will be strong initially as consumer spending and business demand rebound. However, the lingering effects of the pandemic-induced crisis will severely limit the pace of growth. Held down by slow jobs recovery as the stimulus fades. Consequently, we expect that state and local government finances will follow this path with recovery initially in tax receipts, but that will continue to slow and remain muted for the remainder of the fiscal year. So just some questions really remain. There's a lot of uncertainty about forecasting going forward. I mean, really, we're looking at uneven health and economic recovery. It can vary from state to state. We saw places in the South earlier this year that had previously had less severe social distancing restrictions, but then an uptick in cases. So that had an impact on their recovery. And really where COVID is there will be economic consequences that follow, and it's very difficult for our economists to predict that. And there's a number of questions too. When will households venture into the public domain? When will people really feel comfortable going out and going to restaurants, even if they are open, or going to shopping malls? When will businesses start rehiring? There's a really big question here about stimulus, if there's going to be additional unemployment benefits beyond the 300 additional enhanced benefit that some states are choosing to take on right now. I mean, we saw the Republicans in the Senate propose a plan for a skinnied version of additional stimulus that failed this week, and likely, if not passed by the end of this month, we aren't going to see additional stimulus beyond the November election, until beyond the November election. So that could have an impact on what we're seeing in the economy. And then, of course, there's still trade tensions and other issues that we were seeing before COVID that haven't gone away. So I thought that I would highlight next is just that the impact across states is very different. So we're seeing the greatest impact on the economy on states that are heavily dependent on tourism. So you can see that Nevada is really seeing some of the weakest growth in gross state product for this current year. And some of the other states that are showing additional are states that are kind of concentrations in the energy sector. Oil prices and production are down, and that not only has direct impacts on those working in the oil and gas industry, but just ancillary services and regional economies as well. So Alaska, Oklahoma, North Dakota, Louisiana, these are states that have energy concentrations that may not have that tourism component, but are feeling a bit more of the downturn. And then there are states like Maryland or South Dakota or Nebraska that we're expecting to see some sort of hit related to the current downturn, but not to the same level of disparity that we're seeing for other states. So let's talk about kind of some of the more real-time data that we're seeing that backs up what we can expect. So the pace of job gains is continuing to slow, which is an indication that the recovery could be lengthy. The Bureau of Labor Statistics reported that the U.S. economy regained about 1.37 million payroll jobs in August, and nearly half of the jobs lost in March and April have now been recouped, which is great news, but that's the easy half, we think. The next half of jobs is going to take some time as we go through the sticky part of the unemployment pool. The August report shows that signs of longer-term issues developing as all major sectors are losing momentum. The standard unemployment rate, which is based on a survey of households, fell back to single-digit territory at 8.4% in August, which if you're looking at potential BLS classifications could be a little bit higher, around 9.1%. And this is down from 10.2% in July. So more people are joining the workforce, more people are getting jobs, and more people are starting to enter the workforce, perhaps with more optimism that they'll land a job, and more people are getting paychecks, and these are all good signs. And while this improvement is better than we had expected, I just wanted to highlight that the unemployment rate is still twice the pre-crisis rates seen in February. So although there's good news, it's still showing signs of economic weakness. Another thing to highlight is regarding long-term unemployment, and the number of long-term unemployed is growing, though not as fast as in earlier months since the pandemic broke out. The number of people counted as unemployed for 15 weeks or longer crossed the 8 million mark in August from 2 million a year ago, and now represents about 60% of the unemployed, which is, for reference, compared to 34% at the same time in 2019. And in the aftermath of the 2008-2009 Great Recession, long-term unemployment peaked at a little bit more than 9 million. So we're seeing similar levels of long-term unemployment at very short period compared with what we saw the last decade. The number of permanent jobs lost continues to increase, jumping to 3.4 million in August from 2.9 million in July. And this remains well below the depths of the Great Recession. The steady rise in this metric could indicate permanent scars from the crisis. The number of persons on temporary layoff declined in August, but now accounts for about 45% of unemployed, compared with a high of 78% in April. And we think that workers who are unemployed for temporary reasons are at greater risk now of losing their positions permanently. The longer the duration of the pandemic, the higher chances of business failures. And on top of that, if state and local governments, which are some of the largest employers, do not get budget relief from the federal government, there will likely be additional layoffs, and that could mean longer spells of unemployment. Looking at kind of the consumer landscape, it does continue to reflect uncertainty related to the COVID-19 crisis. Consumer spending also seems to have hit a pause after a long climb back, with both low income and high income localities looking a little bit lower through August. Also, I think we've seen a decline in spending in higher income areas, which could pose some headwinds for recovery and really put a dent in sales tax receipts going forward. And then looking at retail sales, they seem to be bottoming out, so that's good news. The retailers that survived the shutdown appear to have at least found the bottom for now, with a slight pickup in retail sales in August. But there's still a lot of pressure on people-facing businesses. And there's various restrictions on capacity, there's expiring government stimulus, and just really customers still fearing to venture out. Just from my experience covering state governments and looking at August sales tax receipts, we did see an uptick, and actually a number were receiving sales taxes in August that exceeded forecasts, which is great news that it looks like we're recovering a little bit better. But I did want to note the timing of the expiring $600 a week enhanced unemployment benefits, as well as other waning stimulus. And so we may see a little bit weaker retail sales going forward than we did this summer. The housing market has actually been a bright spot compared to the last recession. Home sales actually rose 25% in July, which is the strongest monthly gain since December of 2006. So prices are continuing to rise. I mean, this is helped by low mortgage rates, and strength in the housing sector could boost property values and therefore assessed values. And we expect to see more stable property tax receipts, even as we might see other revenues wane. Our latest data from the S&P Case-Shiller Index showed a 4.5% gain in home prices in May. So I think there is demand for people, since they're spending so much time at home, look where they can afford additional housing, are looking for new homes. So what's going on the corporate side? The commercial sector is showing greater weakness than the housing real estate sector, but it's still holding up. Looking at a few telling indicators, retail assets, particularly malls, receive some of the lowest level of rents, and healthcare is also exposed. The senior housing is experiencing significant operating pressure, and social distancing measures and increased work mobility could pressure demand for office space over the intermediate to longer terms as tenants are negotiating renewals on office space. Given the high level of uncertainty over financial health on the commercial side, we think that there is potential to see deferred rent and potentially tenant bankruptcies, which could affect the valuation of commercial real estate. Just to give a little bit more background on what we're thinking about office real estate outlook. We think that there are so many people working from home for the foreseeable future. We've seen a lot of interest in the future of office space and what that could mean for local government revenues. And actually, we're seeing more stability than maybe one would first think. So the sector has typically long-term leases, and that has actually cushioned the impact from this recession. But we could see a desire for more flexible short leases in the future. And we've seen, the lockdowns affect expansions in office space. But we do think that beyond the current social distancing measures that we're seeing now, that there will be remaining a fundamental need for office space with people wanting that human interaction and relationship building. And so, we aren't expecting a large overhaul in large changes for commercial real estate relating to offices. So how does this impact the fiscal condition for state and local governments? So first, I thought I would talk about states, because what happens at the state level can really translate to local governments, particularly given that often when states are troubled, they look to cutting programs to support local governments or even libraries. In July, we published our mid-year view, expecting to have a negative outlook for states for the remainder of the year, which says that we expect that the fiscal composition of states will deteriorate for many, not all, over the course of the year. States have a long history of managing through volatile economic periods. And since the last recession, we've seen a lot of states improve their budget restructures. They rebuilt back their reserve balances, improved debt management, and even with the extreme stress we're seeing tied to COVID-19, we think that many states will actually be okay, and we won't see their finances significantly deteriorate. But really, the response to COVID-19 is going to be at the front and center for the next 6 months. So some of the risks that we're seeing include, how will the pandemic response affect state expenditures and revenues, as we've just discussed? Uh, the potential that federal stimulus may not be there. Uh, States so far, we'll talk about a little bit about the CARES Act and how that's affected state and local governments, but so far that money has been really just for uh, COVID-related expenses and not revenue replacement. We're expecting to see uneven and unpredictable economic recovery, which will make it difficult for states to plan their budgets. And then just other issues that, like the potential for some of the social unrest we're seeing to have political or economic consequences, event risk, wildfires, hurricanes, cybersecurity issues, uh, revenue volatility, and then just rising fixed costs. One of the issues that's been in the news a lot has been rising pension costs, as states were seeing a slow revenue growth in costs related to pensions and Medicaid rising at a faster rate than revenues. While that's not the front and center of our discussion, these are issues that have not gone away even with COVID-19 and can continue to weigh on states. When we're looking at more of the local governments, we're seeing a lot of overlap with the state sector. Interestingly, we've highlighted state sector dependency. So a lot of cities, municipalities, schools receive significant aid from state governments. And if they're not doing well, they may see cuts. And some of the same issues. So to date, no revenue replacement federal stimulus. And I also want to add too that it's not just about direct aid to local governments, but because of the taxes that they receive, any sort of economic stimulus package that the federal government may pass could have a direct impact on local government revenues. Will their reserves or rainy day funds be enough? What's the shape of the economic recovery? Shifting priorities. So, civil unrest and calls for reimagining police operations are widespread. So what is this going to mean for local budgets? High unemployment, what is that going to mean for local businesses and tax revenues? And really just questions about the direction of tax collections. On the school side, again, this is for public school districts and charter schools. Really, we're seeing state revenue pressure again, operating cost increases. Will there be, I think there's a lot of cost savings right now with virtual schooling and students not being in the building, but when or if, and if they're going back to school now, what additional expenses are there related to having the proper PPE or social distancing measures in place? Still waiting on additional federal stimulus and looking at issues like fluctuating enrollment. There could be a lot of changes in enrollment, and enrollment typically for school districts determines the amount of state aid or per pupil funding formulas for schools. And so, how parents feel about virtual schools versus in-class learning versus other, comfort level, parents might be shifting enrollment in ways that are different from the prior year. And this makes it difficult for school districts to predict their budgets, but also could have negative consequences for revenue. And again, just so many questions about the uneven health recovery. So how does this translate to kind of what we've seen so far? I wanted to just give a background. So now I'm with S&P Global, and we're a rating agency. And so we assign credit ratings that are really based on not just the finances, but the economic liability and management profiles of states as well. And the state's ratings distribution is actually very high. States tend to have very strong finances overall. Now, part of that is because unlike a business, states don't declare bankruptcy, states don't go out of business. So, our rating spectrum goes from AAA, which is our highest rating, all the way down to, it goes AAA, then the AA, single A category, triple B, and it keeps going down all the way to C, and then D is for default. So looking at the state sector, this is a very highly rated sector, and roughly a third of our states are AAA. So some of the best credit quality or fiscal conditions that you can think. But we do have that negative outlook, and actually a roughly 1/5 of states now have what we view as a negative outlook, which means that there's a 1 in 3 chance that we could downgrade their credit rating in the next year. And this is really uh, an unprecedented amount of negative outlooks that we've seen. We think that there is potential that we could see a faster recovery. There could be federal stimulus, but given the long tail of the economy's impacts on finances and just the severity of the situation at hand with tax revenues, we think that the conditions could weaken in the next year. We've also downgraded 2 states, Alaska and Wyoming. Those are energy dependent states. And then we revised at all the positive outlooks we had. We had them on Connecticut and New Hampshire to stable from positive. Just for some context too for ratings movements. So we've only had 2 downgrades, but I think it's interesting to talk about what happened in 2016 and 2017 in terms of a lot of negative rating movement. And this speaks to what we're seeing as kind of the long tail that recessions have for state and local government finances. So, right now we're seeing the immediate impacts of tax revenues declining for states and local governments. And I think I had failed to really discuss earlier what sort of ranges that we're seeing, but really we're expecting to see about anywhere from 5 to 20% revenue declines for the fiscal 2021. So it's pretty severe, the gaps that we're looking at. And all but 8 states saw declines in revenues. So fiscal years, for states, typically run on a June 30th basis. So that takes into account that final quarter, second quarter of 2020. And we've seen that roughly only 5 states out of all of them had positive revenue growth for 2020. And essentially all the states that we're speaking to are expecting declines. And it really can vary based on the revenue makeup of the states. So I think it's the Center on Policy, I'll get the source, but I've heard numbers of up to $240 billion in cumulative state revenue declines, which is substantial and could have really a lot of consequences, not just for state programs, but the economy as a whole. So looking at that kind of decline in revenues, how long does it take for state sales taxes or state income taxes to really climb back to pre-recession levels, and then not only get there, but catch up with expenditure growth that is growing at the same time? Really what we saw is a lot of weakness continue after the last recession as the economy grew very slowly, but expenditures continued to rise, which really culminated in a lot of pressure for states even after the recession ended. So we may see that if this economic recovery repeats that pattern of slow growth following this recession. So what we're seeing now just really may not be the end of fiscal stress for state sector. So, as I discussed, state taxes really can vary, and the impact can really vary state to state. So the states pictured here with kind of the orange color are the states that exhibit the highest revenue volatility, so the highest cyclical fluctuations in revenues, whereas the states that are in green exhibit the lowest volatility. So a state like California may have a very deep and diverse economy, but the factor that plays here is that the state has a very progressive tax structure. The top 1% of taxpayers actually pay into roughly 50% of the state taxes. And so you have a tax structure such that if there are significant fluctuations in, for example, capital gains, Due to market volatility, California is going to see a lot of changes in revenues. Some of the states that are highlighted here are states that are very volatile based on commodity pricing. So we've got Wyoming and North Dakota, which have highly cyclical revenues due to oil industry related economies. Also, we're seeing greater volatility this time around for states that are heavily dependent on tourism. So whether that be Nevada or Florida. So while I'm painting kind of a negative picture overall for what we're expecting for state and local government revenues, a lot of it can depend on the composition of your local economy, as well as if your tax structure is built to reflect that. Just wanted to highlight too, states' reserve levels, so their rainy day funds had been growing headed into this recession. So, as of 2019, 2020, we're really looking at reserves that were putting these states in a better position to handle a downturn than the Great Recession. But we're expecting, a significant decline in revenues that for many cases may wipe out completely rainy day funds. So we're expecting that a number of states will need to respond to the downturn through expenditure cuts. I just wanted to highlight too, I talked about some of the fixed costs, particularly pension costs, posing a pressure for state and local government finances as pension costs continue to rise. But again, this isn't really a problem that affects all states equally. So the darker shaded blue here, this is the states that have the weakest pension funding. So Illinois, New Jersey, and this is the source of great budget pressure. But then you do have some states that are doing great. Wisconsin, South Dakota have about fully funded pension funds with a little bit, very minimal volatility and need to contribute to their pension funds. And so really, I just want to emphasize that while we're seeing issues really across state and local governments as a whole, it can really vary state to state. I also wanted to just chat briefly about coronavirus relief funds. So the CARES Act allocated money to state and local governments through the Coronavirus Relief Fund. There were also some other programs such as the Municipal Liquidity Facility that you may have heard of, which is there. It supported Illinois, it supported MTA, so that's a transit system in New York, to support liquidity needs or cash flow needs, given kind of the sudden drop in revenues. And the amount was distributed to states based on a per capita basis. So California, Texas, Florida received more aid than other states. And I had previously mentioned that so far this relief has been to finance COVID expenses and not general revenue replacement. And these monies began to flow to states and locals in April. We think that if there isn't additional aid, there could be further cuts to employment and programs at these states, and that could have an impact on the general economy, which in turn could lead to lower tax receipts. So, laying off a state or local employee isn't 100% savings for the savings of that employee. That employee, gets paid and generates economic activity. So, that's not, states would still be receiving somewhat of a loss in revenues with layoffs. So, we would prefer that, the stimulus would come and continue to support state governments. So there is what we're seeing states spend it on so far. There's been discussion of, well, the states haven't spent all the funds yet. Can't they, so they don't need additional aid. Really, a lot of this aid is allocated to over time. States have until the end of December to spend their CARES Act monies, and many have allocated it to programs already. And so while the money isn't spent, it is being allocated to various COVID-19 relief programs. So, just to conclude, really, we're expecting a pressured fiscal environment for states and local governments through fiscal 2021, so through June 30th of next year. And as revenues may be slow to recover, correlating with a longer economic recovery, we think states and local governments will see lasting impacts. On the brighter side, though, for those that are more dependent on property taxes, we are expecting greater fiscal stability. I want to thank you for having me today. I hope that this was helpful in really understanding what we're seeing in terms of economic trends and how that might relate to state and local finances. We've published a lot of information that is available on our website, spratings.com. Our economic reports are available, as well as specific reports on our view for higher education, state governments, local governments, and public education. Uh, Feel free to reach out to me with any questions about this presentation or as it relates to state and local finances. Thank you.